Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with a man who called it. He called it right. I did not. He said rates were going to 5% very quickly. We are here now, and we could see 6% this year. This is, of course, 30-year money, owner-occ, best financing. So I thought we'd ask, how does the housing market react to what's going on today, Greg?
Well, we're already starting to see reactions. We're already starting to see price declination. So certain areas now, real estate's hyper-local. Every market's different, and there are still hot pockets in every market. Yep. I had a good friend of mine that just put his house on the market over the weekend, listed it on Friday at $2.1 million or $2.2 million sale, wow. Cash offer, and the next day, wasn't even on the market for 3 days. So they're still in cash, so there's still a certain level of the market that's doing well, but our area, very small area, there might be 20 houses on the market right now. That's it. Yeah. So, with a population base of about 70,000 in the city proper.
Wow.
So, my market's very different, but in the Southeast, the Sun Belt areas, which we're kind of below the frost line. So, we're in that kind of area. So we're a popular demographic. A lot of people moving here for different reasons where I live. So, but to answer your question, what we're seeing and hearing across the country is two things. One, we're seeing price, reductions on inventory. We're seeing properties sit a lot longer. Even in my area, there's properties that are overpriced that are sitting. You're seeing deals fall apart, and you're hearing, builders are having issues with contracts falling out that they contracted, their buyers qualified, 6 months ago. They can't qualify for that mortgage now. So you're starting to see some of that. And, other areas are experiencing it even more. And in the commercial market, I'm starting to hear about deals where lenders are pulling the financing at the closing table.
I've heard that too.
They can't commit to that rate now.
Yep.
That's happening over and over. I'm hearing that more and more. And I'm also hearing about deals just falling apart in general because, going in cap rate and financing, when the time they get done with the due diligence, the financing doesn't work anymore. So some deals are starting to, fall out and retrade in the commercial side as well. So interesting.
Yeah, I think commercial is the one that I think, when we look back, we'll fast forward and it's 2025 for a minute here. I think when we look back, commercial will have cumulative more pain because of the debt structure, right? The residential market this time around, heading into this year, 98% of loans were 30-year fixed. That doesn't feel like, a lot of forced sellers. I think there will be forced sellers in the commercial market, right? They went in, they got bridge debt 1 year, IO, interest only. Their value add didn't go as well as they expected. They got flat rents versus 5%. There's all kinds of things breaking in the commercial sector. I'm already hearing. Do you think that's true? You think commercial has more pain ahead than residential?
Yeah, absolutely. Residential, it's going to take time because of the inventory. I mean, it's just record low inventory. So it's going to take some time for that market to correct. And it's going to take rates, going much higher, but it's already happening. And a lot of the buyers, millennials especially, they're just giving up because they're priced out of the market. They can't afford a house. There's nothing to choose from. Prices are too high. And then they're getting hit on the rent side. So to your point, let's take Grant Cardone, for instance. So he primarily uses floating rate debt over 10 years.
Yeah.
So, but there's caps, you can buy rate caps, and I don't know what his exact debt structures look like, but a lot of people have been using 5-year bridge debt that's floating rate, or interest only that's fixed for maybe 3 or 5 years. So a lot of these deals that were done over the last, 2, 3, 4 years are going to be resetting into this new higher rate environment. Now, they've been able to almost double their rents in a lot of areas. And that's the issue. So that might offset, maybe, but there's no money in it. So they have to pay their investors back. So, you're going to see a lot of situations where they can probably, maybe potentially refinance and return capital, but they're not going to make any money.
Yeah, and maybe,
it's really interesting. It's been all over the news lately about how high rents are going. And you and I have talked about it. At a certain point, people are going to push back, and rent, I mean, they can only go so high, and it's already starting to happen. There's people, all over the news this weekend, in Florida, that their rent was going up, I think $1,000 a month or something like that, crazy. Or even doubling. Yeah, and they're like, look, we're moving. I mean, we're not going to pay. I think they were paying $3,500. It's going up to $6,000. They're like, we're just not going to do this. We're in Miami. There's plenty of other options out there. We're just moving. So landlords are going to be pricing themselves out of the market But some of these hot areas, South Florida, Arizona, Texas, I mean, a lot of those hot markets are, the ones that have jacked rents, 20, 30, 40% on people. And, New York's another one where rents have really gone up. A lot of people think New York, all these vacancies.
Yeah.
So office, yes. And what people have learned and what we are learning is that, return to cities doesn't always mean return to the office or return to work. People want to be in the city for the lifestyle.
Agreed.
Not necessarily because they have to office there. So, residential is under a lot of pressure in New York and rates are going up. So very interesting times right now.
Yeah. I want to go back. It just jumped in my head. Someone asked, do you know what your friend who just sold that house for 2.2 is doing? Are they moving to Florida? Are they going to buy something else? Are they just sitting on cash? And if you don't know, it's okay, but I'm just curious because this is a big deal, right? There's a lot of people that have a lot of equity, but usually when you sell, you also become a buyer.
Yeah.
So it's interesting.
Yeah. And it doesn't matter where you go, you're going to be a buyer, but yeah, they're going to stay local. So their options are limited. And that's been a big discussion is, they've been wanting to sell because they're downsizing, kids are gone, big house, so that's, they're going from a very large house and they want to downsize. And we've been talking about it over the last few years and timing wasn't right and things like that. And I mean, even I guess it was 2 years ago, they put the house on the market right before the pandemic and it didn't sell. And that's how much the market's changed. And it went in a couple of days because, one of the highest priced homes in that area. But yeah, they want to stay local. But I've had several friends, my mom included, sold her house over the last, year or two, and she's renting, for the rest of her days. And that's what made sense for her. She thought about buying. I said, no, just rent, your point in life, why have the hassle and the headache and, potential tax increases and all those things, just pay a fixed rent. All her utilities are included. Yeah. And, they're not jacking her, she's got a good, reasonable rent escalation in there. And that's something that you're going to start to see. People are going to start rising up about rent. You're going to see rent controls become a thing in a lot of cities, in a lot of areas, just because of the pressure it's putting on people, because they're going to be facing, people rising up. Number one, they're going to be facing people leaving. Number two. Yeah,
no, I agree. I think when I look at the apartment market, I think there's a lot of negative headwinds. And I think one of them is going to be rent. I think there's a lot of new operators who got sucked into the Fed keeping rates low and cap rates going crazy. I mean, I remember there was an operator who actually said he expected cap rates to go to 2.5%.
Yeah, I'm like, in some areas it might, for a stabilized, fully performing asset in some markets, sure. Some assets, and to your other point about commercial, whether or not it will feel the impacts, certain aspects of it. But let's just talk multifamily, because that's the marquee of the commercial asset class. Commercial real estate asset class. Multifamily residential is the AAA rated bond that you want to buy, and that's how investors look at it. It's the safest one to invest in. They're not interested in office, retail, and all that. Even triple net, single tenant triple nets with A credit clients or tenants. Those are less desirable than multifamily. So that is seen as a bond play. Okay. So there is going to be a lot of capital coming into the markets because they're exiting financial markets right now with what's going on, looking for alternatives. So they're coming in and paying cash for a lot of these assets. Yeah. But you're talking about family offices, you're talking about investment funds, things like that. The traditional, like a life insurance company or a sovereign wealth fund. Sovereign wealth funds can be a little bit more nimble, but like a life company, a pension fund, they can't be direct buyers necessarily, but there is a market, being created for that. Yeah. I don't know. I just see this commercial market. There was something called the TINA trade, right? There is no alternative. Excuse me. And I think that's changing, right? The 5-year note last week was above 3%. It's no longer under 1%. I think as the Fed does what it does, the TINA trade kind of falls apart. That's what we're seeing in the stock market, right? With people rotation into consumer staples versus discretionary versus tech. I mean, if you can get 3% on a 5-year, why would you get, not many people want 2.5 on a riskier asset, I would think. Yeah. And that's the whole reason why mortgage rates are rising, with the bond market, because, they're looking at the risk, right? So why risk, especially residential, which is seen as one of the riskier, believe it or not, even with the qualified borrowers because of what happened 08 and 09, it's still
Yeah.
risky versus multifamily. Multifamily is your safe haven. And, looking at bonds right now, the bond market's been really weird.
Yeah.
But yeah, the 5 years at, 2.78, the 10-year is back down to, 2.8 right now. So bonds have been kind of all over the map. But
Yeah. They came in today.
when you think
of
about commercial
Beijing.
real estate at a 2.5 cap or a 3 cap, you can buy a 20 or a 30 year right now,
Exactly where I'm going with this. Because again, I don't think the Fed's done. I think the Fed's got to get back to neutral. I think they got to get to 3%. That's the funds rate. If the funds rate goes to 3%, do you have a guess where the 30-year might be at the end of the year? If I'm right, which you're not saying I am, but let's just pretend for a minute that I'm right. Fed
you'll
funds
be in the sevens.
Wow. That stops everything.
And it's not based on the Fed funds rate. Obviously, it's they base it off the 10-year treasury because that's where risk is assessed.
Yep.
But if the Fed funds rate goes up that high, then the bond market's going to kind of go up with it.
Yeah.
And stocks are going to be 30% below where they're at now.
Yeah, because when I think about the funds rate at 3, I think the 10 years at 5, maybe 4.755, something like that. And then you got to have a risk. You have to have a spread. Yeah, you could be in the 7s.
Yeah, and I guess we'll talk on the next episode about the Fed and what they're doing because
we will.
The question is, can they get there?
Yeah, we will get to that right now. But before I do, Greg, how can people find you?
Yeah, gregdickerson.com. All my social media profile links are there. Go check it out.
Thank you, buddy.